Well, good morning and welcome back to the Broadcast Retirement Network's BRN Sunday podcast. I'm Jeff Snyder, your host for the next 60 plus minutes as we go around the globe with members of academia, financial services, and the media to discuss all the news in retirement markets, technology, personal finance, so much more. We've got another great show for you this week. Our contributors are raring to go to talk about all things finance. So sit back and relax and enjoy this episode of BRN Sunday podcast. The show and a look at the latest social media trends, and I seem to understand that there's a lot of people out there talking about a lot of things. And joining me on the line, he is LinkedIn Senior Financial Services Editor, Mr. Devin Banerjee. Hi, Devin. How are you?
I'm doing great, Jeff. How are you?
I'm doing well, and I should also add that Devin is the editor as well on the This Week in Finance newsletter, one of the more popular newsletters on the LinkedIn platform. So a lot of responsibility there, Devin. So obviously coronavirus, I'm sure, is top of mind, but why don't you give us a snapshot of what you and the team at LinkedIn are following this week?
Yeah, absolutely, Jeff. Lots of coronavirus news this week. I'm not going to run through all of it, and some of your more market-minded experts coming up on the show can delve into the market reaction. I would say, though, just on the point of the This Week in Finance newsletter, my team has rounded up quite a good global wrap of the market and economic effects of coronavirus. So I would encourage people to check that out on my LinkedIn page. But I'm going to focus on a couple stories that we've been featuring and seeing some really strong conversation around, which is these stories around fintech the past couple of weeks. It's been a really big couple of weeks for fintech. Of course, Jeff, you and I spoke last week about Morgan Stanley buying E-Trade. Yeah. This week, we also featured the news about Intuit agreeing to buy Credit Karma for just over $7 billion. One of the smaller stories that didn't get a lot of attention, but I picked up on some great conversation on, is Lending Club agreed to buy a bank called Radius Bank. Pretty small deal, less than $200 million. I think it was about $185 million transaction value. And what's so significant is it's turning Lending Club, which you know is one of actually the oldest fintech startups out there, into a regulated bank. So Lending Club is buying this regulated bank, pending regulatory approval, of course. But it's one of those moves where we see fintechs really realizing that they need to be on the right side of regulation, and that if they want to expand their product suite and offerings even more, that getting that bank charter is kind of a necessity. And so an acquisition to do that is quite rare versus applying for a charter or partnering with a chartered bank. So that was quite significant. A lot of people talking about that as potentially a harbinger of things to come.
Devin, and I seem to recall that, and you could correct me, because we talked about this several weeks ago or a month ago. There were someone had pulled back a request for a bank charter. Who was that? Because I'm pretty sure.
Yeah, that was Robinhood, actually, which is kind of one of the shiniest, flashiest fintech startups out there right now. And there wasn't any really detailed reporting into why they pulled it, but I think it's fair to say that process is lengthy and involves a lot of scrutiny, and perhaps they did not see a path forward to obtaining that charter. And so in the past, a lot of fintechs, as you and I have talked about, have ended up partnering with larger established financial institutions so the fintechs become kind of the top of the funnel, bringing in new users, new customers, and then they can pipe people over to the services that banks offer. So interesting move here by Lending Club in terms of acquiring a regulated bank. We'll see if we see some more of that. I also wanted to point out in the UK, across the pond, Revolut, which has about 10 million users worldwide. It's one of these neobanks, digital banks, who just raised a recent funding round about $500 million, valuing it at $5.5 billion. So it's now one of Europe's most valuable fintech startups, alongside another one called Klarna, which is a lender in Sweden. But we're seeing fintech really kind of race across the globe, is my point there. And staying on this point, one more interesting story we featured which was CB Insights annual report. CB Insights is, in my opinion, does some of the better fintech research out there, along with some others like PitchBook. But their research for 2019 showed something interesting, which is overall fintech funding slowed a bit. About 33 billion was raised. That's down from 40 billion the previous year. But what they found was that financing for those early rounds for fintech startups, like Series A rounds, was what really actually dropped to a 5-year low. But funding for Series B and C and later rounds actually hit a 5-year high. And a lot of people pointed out what this might be pointing to is a saturation point in the fintech market, where it's getting harder and harder to be a new entrant in this new market among the fintech startups. And especially because of what I was just saying a couple minutes ago, a lot of these fintech startups have ended up pairing up and partnering with the larger financial institutions. So if you're a new fintech entrant into this market, you may not be able to find those partners because many of them have already partnered up. So I enjoyed that kind of nuanced take on the fintech market because it's really been evolving a lot over the past couple of years.
Yeah, it seems to be that, in the past, investors would throw money, dollars after dollars or whatever, at these fintechs. And it seems like there's a little bit of a higher hurdle rate, or not
Exactly.
rate, excuse me, a little bit of a higher hurdle now to get that funding. It seems that you're indicating that these different research organizations are saying. And being that, and you were leading into the conversation about a harbinger of things to come, and I would agree. I mean, do you think that a Robinhood, they pull their request for a charter, now they go out and try to partner with somebody? Because Morgan Stanley just buys
E-Trade.
E-Trade, thank you, and Schwab buys TD Ameritrade,
right?
And that kind of like you could be left sitting outside.
Right.
Looking in, right? I mean, that at the end of the day, that could happen.
That was exactly what a lot of the conversation was. As soon as that Morgan Stanley E-Trade deal was announced, many people saying, what happens to Robinhood now? And there was some fun, rumor and speculation, of course.
Yeah, that's always good for some conversation.
Reporting on this.
Right.
Yeah, it's the Twitterati, as they call it. But yeah, a lot of people coming out and saying,
I've not heard that.
And saying, look, Goldman is probably looking really, really hard at Robinhood right now, and there's probably some courtship, slowly unfolding, because Robinhood's out there alone, and it's got north of 10 million users. It's got a great user interface and experience, and some of these big banks, which are trying to move into the consumer space, like Goldman has been trying, could definitely be interested. So a lot of attention on Robinhood right now, definitely.
Yeah, and just to kind of a couple minutes left, just to tie back the coronavirus stuff. Obviously, a lot of trepidation as we're chatting now. The markets still have not had a positive run. We've had 4 or 5 days of bad news and bad market news in particular. Anything that you can say from the folks on LinkedIn, what types of conversations you're having? Not you, but people are having.
Yeah, definitely. Yeah, there's a lot of talk this week just about markets kind of seizing up, the capital markets kind of seizing up, definitely in terms of the credit market. A lot of outflows from bond funds. And we've also seen some people talk about the IPO market and M&A market really taking a hit this year, likely. I think we saw DoorDash confidentially file for its IPO. A lot of people kind of scratching their heads at the timing on that one. But yeah, I'm seeing that. I mean, I used to cover M&A and private equity quite a bit for years, and some of my old sources are definitely looking at some issues this year. Just confidence taking a hit, uncertainty rising. That said, some of the private equity players actually, which are sitting on huge piles of what they call dry powder or uninvested cash, are excited a bit. There's a huge private equity conference, the biggest of the year, this past week in Berlin, Super Return, which I skipped after 8 years of going. But a lot of the talk there I read was about some prices looking a little bit better, valuations coming down for just some run-of-the-mill attractive businesses that aren't taking a direct hit from the supply chain ripple effects related to coronavirus, but just as the market kind of swoons, multiples are coming down a bit. So there are some private equity players excited about that softening in the valuation environment right now.
Very interesting. Well, I think it's, we've got earnings, we've got GDP to look for, we've got other economic tea leaves. I think you're going to be very busy, Devin, writing and looking at some of these conversations in the next few weeks, because I think we've given back a lot of our gains and a lot of our gains last year. I think there's some trepidation by just average Americans concerned about their savings. So we'll see what happens.
Yeah, definitely. And I would just say on that last point, there is a lot of fear mongering. I don't know if that's the right term, but a lot of information being thrown at people from all sorts of outlets. I mean, if you have CNBC on, it's just red flashing chyons and all that. I would just remind people to really look at trustworthy sources, to think about, financial advisors that they trust if they have one. We on LinkedIn are doing our best to really cut through the noise and separate the wheat from the chaff. So my This Week in Finance newsletter this week really just highlights the most kind of factual effects of the coronavirus so far. We're also featuring at the top of the LinkedIn feed a collection of posts and videos directly from places like the CDC and the World Health Organization. So you can go to one place and just get the facts directly from the source.
Yeah, well, really, really good reporting, really good information, and I guess more to come. And just a quick note: Devin normally appears on Mondays, but we're going to change things around where Devin appears now on Fridays. So we'll try to time it better with his This Week in Finance content, because why not do it on a day to coincide with a day where he and the team are originating new content. So. Devin, always a pleasure talking with you. Thanks for, as always, kicking off the show in the best way possible, which is a look at the latest trends. We'll talk to you again very soon.
Sounds good, Jeff. Take care.
Bye. Welcome back. Now we're on to tech news. Joining us on the line, he's a senior technology and consumer product reporter for The Motley Fool, Mr. Daniel Klein. Hey, Dan, how are you?
I'm good. How are you?
I'm doing well. Obviously this market upheaval is really causing a little disconcertedness within, personally for me. But what are you going to do?
Hey, it's an opportunity to buy.
It is. If you're young, yeah, I agree with you. But a lot of people, you have that irrational thinking that often occurs. So people just need to put that emotion aside. But it's hard to do. But I want to talk tech with you, and I could talk about a lot of topics with you, and we do that all the time on the network. But let's talk about what's top of mind from a tech perspective with you and the folks at Motley.
Yeah, so we've covered this from all sorts of different angles, but Amazon opened its first, let's call it full-size grocery store. It's only about 11,000 square feet, so it'd be on the smaller side compared to, say, a Publix or a Stop and Shop, but it's basically a full-service grocery store, and it has the Amazon Go wireless, no cashier technology. That means you walk into the store, you open an app, you put the items in your cart, and you leave. You don't have to stop and check out. It charges you through the app. It's very easy to use, pretty seamless technology, and that in itself is an edge for Amazon. It's definitely nice that you don't have to do that, but that's not the real advantage. The real advantage is that by not having cashiers, you're saving on expense. Of course, there's an upfront investment, but you'll pay that back eventually. And when you don't have that expense, you can lower prices. So GeekWire, one of my absolute favorite websites, did a study of prices at the Kroger-owned QFC, which is a grocery chain out in the West Coast, and the Amazon store, and it found that if you had a Kroger or a QFC loyalty card, Amazon was about 5% cheaper. If you didn't, Amazon was about 25% cheaper. And this sort of underscores a bigger reason Amazon is going to succeed here. Amazon has the ability to lose money or break even on its grocery stores to win market share and change consumer behavior. I liken this back to how Dunkin' Donuts expanded in New England. Back when I was a kid, there were a lot of local donut stores, and Dunkin' Donuts would open nearby, and they wouldn't get the locals, they would get the people driving through. But skimming off that 10-15% of business was enough to put the local company out of business. So Kroger and other grocery chains, they make their money selling groceries. Amazon doesn't have to do that for a long time. So they have a really strong competitive advantage to go in and be cheaper. That's magnified by not having to pay cashiers, but it's really more based on the fact that Amazon is such a large, powerful, cash-rich company that it can kind of come in and undercut you as a way to win business.
Dan, how many lessons were learned from the Whole Foods, right? They bought Whole Foods, I think, last year, or the year prior, or maybe it was a couple years. I mean,
Yeah,
what kind of
it's a couple
lessons?
years ago.
What kind of lessons were learned there?
Well, I think they learned that the Whole Foods market is only part of the addressable market. Even with lower prices, and they have in some places lowered prices at Whole Foods is an upscale grocery store. It sells, higher end products. It doesn't sell Coca-Cola. So a lot of things that Amazon sells on its website or through its grocery delivery service, it can't put into a Whole Foods, meaning it can't take advantage of the fact that it has this ability to buy the items at lower prices. Hence, that's why it's launching a more traditional grocery store. It can take advantage of its supply chain and all its pricing power and be able to go out there and sell you pedestrian brands. There are no Fruit Loops at Whole Foods. Amazon Go can sell you Fruit Loops.
That's true. That's true. There are no Fruit Loops. I mean, it's a very health conscious brand, Whole Foods is. It's certainly going to be interesting. I mean, just from a macro point of view, Dan, I mean, Amazon getting into so many different lines of business. I mean, think about where they are to where they have been to where they are. Healthcare, I think we've talked about. It's just amazing what they can revolutionize. And you're right, when you are a cash-rich company, you have opportunity that maybe some of the other organizations like Sears is one we kind of beat up on last week, right? Is an example where one that just is not doing well. And
Yeah, if you don't have money, it's hard to evolve. And while Amazon has generally grown in areas that either came out of its own need, that's where AWS, Amazon Web Services, comes from. That was something it created for internal use that it then made an external product.
Yep.
Or opening grocery chains is adjacent to what it sells online, adjacent to the whole food business, and it sort of just expands something it's already good at. And with the advantage of being able to sort of endlessly invest, I'm actually surprised more companies that are in this kind of situation don't do it. If you look at, say, an Apple, they could be moving into other areas that are supported by their sort of hold-on customers. And really, this is just Amazon saying, hey, you like shopping with me? Here's 10 different ways you can shop with me.
Yeah, I hear you getting a call. That probably is another podcast calling you. But let's.
I'm turning it off. It's actually someone confirming an appointment for tomorrow.
Oh, okay. Well, I hope everything's okay. Let's shift gears. I know you wanted to talk about Bob Iger stepping down from Disney, and then we wanted to also go into possibly Disney Plus. So why don't you talk about Bob? Mr. Iger, I don't know him personally, obviously.
Yeah, so I think this has been sort of misreported. You just use the word, and every headline, probably even my own headline, used the word stepping down. And then the reality is, Bob Iger is stepping up. He is going to be executive chairman of Disney. When you put the word executive before chairman, it means chairman who comes to work every day and still runs a bunch of stuff.
Yeah.
He's going to be supervising creative, but the new CEO reports to him. So this is a succession plan. It's a way for him to handhold Bob Chapek, the new CEO, and sort of show him the ropes. But while Iger is saying he will retire in 2 years, in 2021, when his contract expires, if this goes smoothly, there's no guarantee that will happen. Iger has had 5 separate retirement dates. And, if this is a way for him to deal less with the day-to-day and more with the stuff he likes as a way to keep him on board for a longer term, that's very smart. He has amazingly transformed Disney under his watch. They bought Pixar, they bought Marvel, they just bought Fox, they launched Disney Plus, which is wildly successful. So this is really Bob Iger realizing he's not going to live forever, coming up with a logical succession plan, and Disney has generally sort of pushed executives out after a certain age. They're not going to do that with someone this successful, and it's a way of him figuring out, what's next for me? And what's next might be that he stays in a chairman role at Disney beyond 2021. No one's saying that, but he hasn't left a lot of times before. So there's kind of no reason to believe he's going to leave now.
Well, Dan, couldn't they make Bob Iger part of the Hall of Presidents and therefore he could live forever?
Well, there's actually a lot of talk that he might run for president. And I think that would depend a lot on how this year's elections go. If there's a Republican in the office, 4 years from now, I see Bob Iger as being a very viable candidate, sort of, a more palatable version of Howard Schultz or Mike Bloomberg,
Right.
someone who's charismatic and well liked and probably would go about it the right way. On the other hand, he's building a sailboat. He may decide he wants to spend more time on a sailboat, but he also wants to help grow Disney Plus and continue to help with movies and the other things he likes. This is a man that can pick and choose whatever he wants to do because pretty much everything he has touched has turned to gold.
Yeah. Let me ask a question about. I want to talk about Disney Plus because I know that's been a hot story. We've covered on the network previously. Additional thoughts on that because people thought it was the Netflix killer.
Yeah, so I never believed Netflix killer because I've always assumed that cord cutters are going to have somewhere between 2 and 5 services. That depends on how many people live in your family. I have more than that, and I'm not necessarily going to count if you buy the $12.99 Disney Plus bundle, which gives you Hulu and ESPN Plus. I'll count that as one service, not
Yep.
3. But if you get that plus Netflix plus maybe some niche service and you ship those out as you need them, you have an awful lot available to you. But there's simply too much on Disney Plus to pass up, especially if you have a family. There's no R-rated content. That's all being shunted to Hulu. So you're not going to have your horror movies, your more grown-up dramas. But if you have kids, if you have even teenagers who are let's call them Star Wars and Marvel aged, though I'm big fans of those things, and I'm by no means a teenager.
But you're a kid. You're a kid.
Yeah, I do. But I would have Disney Plus whether I did have a kid or didn't. Let's be honest. But the reality is Netflix also has a very deep bench of content. And they're losing a few things. They're going to lose Friends. But I don't buy that anyone is a Netflix subscriber or that too many people are a Netflix subscriber for any one piece of content. For me, Disney Plus, the library is not that big an appeal. My son and I aren't sitting around watching Toy Story 2. On the other hand, The Mandalorian was a huge draw,
Yeah.
and they just released the first episode of the final season of the Clone Wars, which is not as good as The Mandalorian, but it's a show I watched and followed when it was on previously, so it's something I'm excited about. And they're releasing just enough original content, but all of it's blockbuster. All of their Marvel shows, they might be 6 episodes, 8 episodes, but they're all movie quality stories starring the movie actors who played those characters. So it's very big ticket stuff. So it's not a Netflix killer. It's an everything else killer. It's a CBS All Access killer. It's a Peacock killer. It's a flitting around on YouTube killer. But Netflix is simply too ingrained and just has too big a library. Like, I don't watch a lot on Netflix, but my wife would stab me in my sleep if I got rid of it.
Well, come on. You're a big Baby Yoda fan. I know we've talked about that. By the way, Dan, I am waiting for the Baby Yoda plush figure to come out so I can get one or make it available so that there are inventory because I want one.
I am a fan of the child. And Jeff, just as an aside here, let's pull it back to Iger and Disney and the whole thing.
Sure.
So I spent the weekend at Disney's Hollywood Studios, which is home to Galaxy's Edge, the new Star Wars land. And I will say I went through the whole rigmarole. It's very difficult. You have to get there an hour early. It's sort of a luck of the draw. I had a few tips, and I got to ride Star Wars Rise of the Resistance. And this is Iger's triumph. It is an 18-minute ride that uses multiple different ride technologies, and it's just fun. Like the level of immersion is incredible. There are scenes where you see animatronic stormtroopers that it literally scares you, where you look up and there's AT-ATs, full-size walkers, and they feel real to life. The whole land is immersive. The second you cross the gate, you can't see anything else. You feel like you're on the planet of Batu, and everyone who works there interacts with you in slightly different localized language.
Uh-huh.
But Rise of the Resistance is going to change, what a big ticket theme park ride is. And Iger gets a lot of credit for putting up the money, going to the board and getting the money to what is the most expensive and biggest addition in Disney theme park history.
Just on that, I want to close with, I've been reading a lot about that Disney bought Star Wars. I would say, the movies, the sequel trilogies kind of met with some mixed reviews. But I've been reading, Dan, that they are going to create more shows. So you mentioned Clone Wars, you mentioned Mandalorian, but I've seen and more movies. What's your thought about dilution of the Star Wars brand? I mean, is there ever a point where that happens?
I don't think they can dilute it on Disney Plus with high quality television. I think as long as the shows are well done and they're made by sort of auteurs, the way the Mandalorian, Jon Favreau, has sort of overseen it, there are so many stories to tell in that universe that, sure, if there were 5 23 episode a season Star Wars shows on, that might be too much. But if there are 5 8 to 10 episode shows, that's basically the equivalent of like a show and a half. And if they're all good, I'm going to watch them. With movies, I think they need to be a little more careful. I could have told you Solo wasn't going to do well because I don't think anyone really cared about Han Solo's origin story. On the other hand, if they make a movie about the 20 years of Darth Vader's life that haven't been covered, that would be really compelling. The rumor I've heard is they're going to go 200 years in the past and look at what they call the High Republic period. But right now, everything is just sort of rumor. They haven't really told you. They said the Skywalker saga is over, but I have a hard time believing that in the next 10 years, they're not going to revisit Rey and Poe and Finn and Rose and some of the characters that are left from this original 9 movies. There's definitely stories left to be told. They just have to tell the right ones. I think the long-delayed Boba Fett movie probably would do very well.
Yeah.
The Obi-Wan Kenobi series, which looks like a 4-episode series, I can't imagine that not being a massive hit. So I don't think there can be too much Star Wars as long as the quality is good.
Yeah, some more to come on that. But Dan, always a pleasure talking with you. See, we went all over the place. I think the audience, it's like a podcast within the podcast.
Well, Disney gives you a lot to talk about.
That's true. Dan, always a pleasure talking to you, and looking forward to seeing you again on Tuesday on the television network.
I'll see you Tuesday.
And before me, they got a trick, I have to find a contraceptive. You never know, she could be earning her man and learning her man.
Welcome back, and now we're going to shift gears, talk markets, and obviously there's a lot going on in the markets today. And joining us now to help break things down is Kevin Kelly. He's a co-founder of Delphi Digital. They are a cryptocurrency research firm. Kevin, thanks so much for joining us and making some time for us today.
Absolutely. Appreciate you having me on.
So let's just jump right in. I think the issue hanging out here is that we've had 4 or 5 consecutive bad days in the market, and I think people out there are probably, maybe in some cases, being very emotional about it and reacting negatively to what we're seeing. What's your take on this? Let's break it down there first, and then we'll go into crypto.
Yeah, you finally have seen, risk assets, specifically stocks, really catch up to, what I think was the broader narrative surrounding coronavirus. And we talked, I think, last week or a couple of weeks ago about how the bond market and the stock market were essentially sending completely opposing signals. And, eventually the stock market essentially caved to what bond investors have been trying to say for a long time. And that was that the seriousness of coronavirus and the uncertainty that surrounds, the fallout from it was certainly to be, not just a short-term risk, but it's seeming like it could be something that has a little bit of legs to it in terms of its economic impact. And so what you've seen this week, we've literally seen The S&P, I think now is something, 14, 15% off its all-time high, which was just middle of last week.
Yeah.
It's the fastest correction, below 10% or 10% sell-off from an all-time high in the history of the index. So when you think about like how quick this move was, I think this is one of those times where, again, if you're a long-term investor, especially if you're someone who's looking at their 401k right now, it is a time where it does pay to be disciplined and not make any really rash decisions. Because again, on paper, looking at paper losses is never fun, and I still think it's too early to tell where this market goes, because you really don't see market bottoms until negative news comes out and stocks stop reacting, or even potentially, get a little bit of a boost even as more negative news comes out. And we're still seeing stocks get hammered on kind of every negative headline. So still too early to say where this falling knife, I think, ends up dropping to. But again, it's not just stocks. It's junk bonds. It's even investment grade bonds. Pretty much anything outside of treasuries. I mean, even gold is getting hit today, because I think what you're seeing is more of a kind of race to liquidity and trying to investors basically selling anything that they can, and really kind of funneling into U.S. treasuries, which are still by and large seen as the safest investment that's out there. So it is some really interesting action that's been going on the last week.
So Kevin, I mean, we have earnings coming up, right? We've got some firms reporting earnings, and they're already saying, hey, look, we're not going to meet our expectations. I mean, there's already sending out signals. And then we also have, I think it was, I don't know if it was the president or someone talking about GDP. We're not going to get close to that 3%. So clearly there's some headwinds, at least in the short term here.
No, absolutely. I think what it really comes down to, and again, it's a very difficult question to answer, is, when you think about markets are discounting mechanisms, right? So when you see the S&P off, 10, 12, even 15% from its all-time high in a very short period of time, the question for investors is what happens next, right? And how much of the potential loss in whether it's economic activity or earnings growth or whatever it may be, how much of that is really going to be lost to this? And is it going to be something that's a bit more short-term in nature that certainly has some effects as we get into the spring? Q1 probably even affects, Q2 and maybe even Q3 numbers. But I think the real question here is, are we nearing a bit of a bottom where markets have now kind of priced in a lot of this short-term economic growth hit, or is this actually something that's going to be more systemic and markets have further to fall?
Yeah.
And that's honestly a question I'm currently grappling with and putting together a report on, where we kind of see the inflection point in markets, because we've been talking about this for a number of weeks now, and then actually tweeted something out last week that ended up being kind of the high for the stock market. Just so happened, hindsight being 2020. So that's kind of the moment we're at right now, is how much of this is now priced in. And if you think that things will continue to get worse, it's not even necessarily that things will get worse, that things will get worse than are expected right now. And you could make the argument that consensus right now is really prepping for this kind of doom and gloom scenario, right? And so the argument could be that if you see, some of this data come in not nearly as bad or not quite as bad as people expect it to be, not necessarily saying it's they're optimistic numbers, but they're less pessimistic numbers, that certainly could actually give a boost to markets that are certainly pricing in a pretty doomsday scenario right now.
But Kevin, we've had circumstances over the last few years, where we've had extreme volatility and the markets have gone down. I talk about it throughout the show, point to the Iranians bombing oil refineries, right? I think that happened in the middle of last year. You have different events that have rattled the markets, and what winds up happening is we see a decline, a short-term decline, and fundamentally the economy looks sound, right? And then it pops back up. I mean, is that possibly an outcome here?
It's possible, and I think the big difference here, and why you're always cautious to say this time may be different, but the argument for why this actually could be different is, even if you look at the sell-offs throughout this kind of post-financial crisis, the last cycle, right over the last 10 years or so, a lot of those had to do with declining or falling growth expectations. A lot of that surrounded China. You had early back in 2011, 2012, obviously the European debt crisis, and so what I think is interesting this time around is that this isn't necessarily something that a monetary policy headline, like the Fed coming out and saying they're cutting rates by 50 basis points effective immediately. This isn't necessarily something that the Fed can actually solve and try and prop up, because some of the earlier cycle sell-offs were focused around growth, and then the Fed would come to the rescue and basically say we're going to help prop up markets by decreasing the cost of borrowing and basically trying to spur economic growth that way. Whereas this, if the Fed drops rates or if rates drop 50 basis points, that doesn't force people to get outside their homes and actually go and consume and buy more products, right? It's something that's a bit more fundamental or removed from monetary and even potentially fiscal policy. So I think that's what's potentially different this time around. What makes the uncertainty around it quite scary for a lot of people is that they don't know where this ends, because it is kind of that black swan event that no one was really preparing for.
Right. So let's shift gears and let's talk about crypto, because there has been points in the market, Kevin, where crypto has been almost like a safety asset, right? I mean, people have had a flight out of some of these more riskier assets to crypto. Where are we now in the crypto cycle? How Bitcoin, Ethereum, Ripple, others? What can you tell us is going on there?
Yeah, I mean, the crypto market, first off, I mean, a lot of the crypto assets earlier this year, really heading into, mid last week, I think got a bit over their skis. And so we expected a little bit of a pullback within the alternatives, but I mean, you're seeing the crypto market really take it on the chin, especially Bitcoin, just like, stocks, junk bonds, a lot of these risk assets. And I mentioned even gold throwing in there because I initially thought, and it's still a possibility, that Bitcoin potentially could be trying to tell us something that other safe havens simply weren't. Because if you rewind the clocks quick to early 2019, you actually had Bitcoin rallying and kind of starting its uptrend and its run up, before gold or even treasuries caught up to the fact that the Fed was going to be cutting rates. And so if you think about that, and then it topped out before other safe havens did, in June, and then gold topped out in September. And then you had the Fed kind of going to a more neutral stance, right? So again, there's only a handful of recent events you can point to that show potentially Bitcoin sniffing out things before other assets did. But the more I'm digging into it, I think it's also a matter of the fact that, again, this is people searching for things they can get in and out of relatively quickly. Has liquidity for Bitcoin is certainly higher than more liquid investments, even like some junk bonds, but really kind of your VCP type plays, private placements, whatever it may be. And so I think, with the fact that gold has sold off pretty significantly as well, at least today, I think that's telling you that, it's more so a function of mass panic and kind of investors hitting the panic sell button across asset classes or pretty much anything they can get out of. And it's not so much, macro driven, I guess you could say.
So in the last couple minutes, what should people, as we go, this is going to play on Sunday, what should people be looking for in the week or weeks to come, just the layperson as they're watching this? I mean, is it just really like we're just corona, the number of cases, the number of the cures, where that's popping up, or are there things that we should be looking at?
Yeah, definitely look for any type of glimmer of hope in terms of progress for whether it's phase 1 trials of some of these potential vaccines that are being proposed. Again, the timeline is still pretty stretched, and from a lot of what we're reading and looking into, it sounds like the earliest you could actually kind of mass produce or mass distribute a vaccine for this would be somewhere around probably 11 to 12 months from now. But I think what's important, going back to the consensus idea, is basically, right now, at least in my opinion, the market is pricing a really doomsday scenario and is expectations for cases to rise and this to become, really a global pandemic, essentially, is starting to get priced in, right? And so that's an important thing, is that even if the number of cases we know is going to rise, we know it's going to rise here in the U.S., the acceleration of that is expected to be pretty, could potentially even be, kind of exponential. If you don't see those things come to fruition, I think that's when, again, not investment advice, but that, at least for me, would be a signal that we might be nearing a bottom in some of these, riskier assets. Because, again, you have to always consider what is market consensus. And market consensus right now is certainly pricing for a very, very doomsday scenario. I mean, the U.S. 10-year treasury yield is literally at its lowest point in history, right? So it's really, really prepping for this doomsday scenario. And if you get any type of glimmer of hope, I think that could certainly reverse things a bit.
Well, Kevin, thanks so much for breaking this down for us. And I guess we have a lot to look for going into next week and in the weeks that come related to the coronavirus and seeing the fallout. So I guess we'll be checking in with you more next week and the weeks to come.
Absolutely.
Thanks, buddy. Have a great weekend.
Thanks, Jeff. Talk soon.
Bye.
From a young G's perspective, and before me they got a trick, I have to find a contraceptive. You never know she
Back now, we're going to shift gears, talk a little personal finance. And joining me on the line from the Motley Fool, she's personal finance reporter there, Miss Mari Backman. Hey, Mari, how are you?
Doing well. How are you, Jeff?
I'm doing okay. Happy almost Friday and happy almost weekend. Great to talk with you. Always a pleasure hearing your perspective on so many things going on in the market and the marketplace. So what do you have for us this week? I mean, lots going on, obviously, with the markets and coronavirus, but you take it away from here.
Yeah, so obviously this coronavirus is a scary thing because, you're hearing lots of talks now about a pandemic. Obviously, we want to keep things in perspective. While it's certainly scary, we have to just remember that it's still, in terms of volume, it still actually pales in comparison to the flu, which, statistically at least thus far has had a, higher mortality rate associated with it, unfortunately. Yeah. But there's a lot of fear around the coronavirus, Jeff, because it's new and there's still a lack of understanding as to how it spreads and exactly what impact it's going to cause is yet to be determined. But it definitely has been shaking up the market as of late. Both the Dow and S&P 5 tumbled earlier on in the week, and there's a lot of volatility going on right now. Nothing new for the stock market. The stock market, can be very reactive, but this whole coronavirus scare is definitely shaking things up. It's not just the health impact, Jeff. We're bound to start seeing some supply chain issues coming out of China, which could impact just countless companies. So, investors are reacting, and there's been a bit of a sell-off.
Yeah, I've definitely seen that. Obviously, this week. Obviously, the hot story. What about consumer confidence? I mean, that was at an all-time high up until this market dip that we had. I would imagine that the market confidence or the consumer confidence would dip a little bit as well.
Yeah, I think we're seeing a dip, but also I think we have to remember that that's sort of what tends to happen anytime there's news. It doesn't have to be a virus or an illness per se. Anytime there's really, whether it's like something political in nature, anytime there's some sort of upheaval, whether on a national or international basis, the stock market reacts and investors react. The important thing, though, is for individual investors, people like you and me, to not react. Don't go selling things off now, just because the stock market's having kind of a crazy week. It's hard to say exactly how long or short-lived this current bout of volatility will be. Statistically speaking, in the past, when there's been stock market reaction to something similar, like when there was the SARS virus a while back, statistically speaking, the response has been somewhat short-lived. So this is not necessarily going to be the thing that kicks off a recession, so let's not get crazy just yet. But I think the most important takeaway for individuals is just sit tight and don't react. I always like to remind people, Jeff, that the only way you actually lose money in any kind of stock market correction or any kind of downturn is if you go ahead and you unload stocks and you sell them at a price that's lower than what you paid for them. If you don't sell anything, if you don't do anything and you sit tight, what you're really looking at is, it's called a loss on paper. And these days I like to call it a loss on screen because most of us don't check paper brokerage statements anymore. We log on and we look at it on the computer screen. But, you might have had a portfolio balance last week of $100,000 that's now worth, 91. You didn't lose $9,000. the only way you're going to lose that money is if you actually go off and sell something.
That's
just keep that in mind.
Yeah, I think that's really important. And I was going to ask you about the lessons here for consumers, people listening to the show and watching the network and watching this. I agree with you. I mean, if you move money around today, it's almost like a too late kind of point of view. I go back to 2008, Maury, because I think that frames
Right.
a lot of people's perspective, not just as, and I think that's why people are very afraid. Are we going to reach the precipice again, have this big meltdown? Are we going to lose money? And a lot of people chose to move money at that time and really locked in their losses. I think it's hard to resist that emotional toil that comes from as a result of watching the headlines and hearing the news.
Absolutely. I mean, it's very difficult to sit there and watch your net worth take a tumble. The thing is, I mean, one thing though that I always like to keep in perspective is that our last recession was really a major one. I mean, that was a long one, and not every recession is going to be like that. Also, a week of volatility or even a correction does not necessarily imply a recession. But that said, it definitely doesn't hurt to be prepared for that sort of scenario, and that kind of goes into another piece of actionable advice that people can take away from this. Have some money in cash in the bank. Have an emergency fund. Have money to cover a few months' worth of living expenses, say 3 to 6 months worth if you can. Because that way, first of all, you won't be tempted to have to cash out stocks at a loss if you need money, right? If you're in a position to be able to leave your portfolio alone, then you don't stand to lose anything. But if you've got, $700 in the bank and, a bill comes up, or even, you lose your job or your hours are cut or something happens and you need more than that few $100s that you have in the bank, yeah, you may have no choice but to go and sell investments. But you shouldn't really be putting yourself in that situation. I always tell people, and you'll hear different numbers around this, Jeff, but I always tell people that your money should not go into stocks unless you're confident that you're not going to be using it for at least 7 years.
Yeah, that's
7
smart.
years.
That's smart.
Yeah.
And then you need to live off your cash flow, so meaning money coming in. So a lot of Americans live paycheck to paycheck. A lot of Americans don't have that emergency savings, and that's a critical thing that people need to be working on. And I know you and I have talked about this in a lot of different contexts, but that's really important. Maury, I think, people need to it's important to know the news, right? But I don't think you have to follow Twitter and Facebook and the news on an hour-by-hour, minute-to-minute basis, because you're just going to make yourself crazy. There's a lot of things that people don't know. What we do know is that there's a virus. It's infecting people. We know that it has spread to beyond China, right? And we know that the stock market is reacting. But candidly, the stock market reacted last year when I think the Iranians kind of rattled their sabers, right? Or when North Korea rattled its sabers. So there's a lot of things that can
Jeff,
move markets.
let's not forget the fact that it's an election year. We're going to see turbulence, in the coming months just by virtue of that alone, right? So, there's definitely a lot of factors that can drive the market into craziness. I totally agree with you. There's really no sense in checking your portfolio balance every day. Of course, it's a good idea to check in every so often, maybe quarterly or 3 times a year, something like that, just to make sure that, you're comfortable with the way your assets are allocated, and just to make sure that you don't have a couple of real, what I call loser investments hanging around, as in, for example, if the market is generally up and you've got just a couple of stocks in there or funds that are just, not producing returns, you may want to, just rethink those if they're kind of bucking the trend.
Yeah.
But yeah, exactly. You're gonna drive yourself nuts if you're, paying attention to every single tiny move the market makes, or even big moves. I mean, there was a lot of movement this week, but again, if you're not planning to sell anything this week, you're okay.
Yeah, I think you're right on that. And as an aside, the financial industry, it used to be that you get your quarterly statements and you would sit down with your financial advisor or even log online and make a change. Now with daily valuation, which is essentially what you and I are talking about, whether it's in your retirement, whether it's in a brokerage account, I really feel like that kind of set the world on fire in terms of incentivizing people to make trades and to try to change their positions on a regular basis. I wonder what the world would be like if we didn't have that level of flexibility, meaning you still got your daily value, but you couldn't make an exchange or you couldn't trade on that daily basis. Do you think people's behavior
Right.
would change? Do you think the behavior wouldn't change?
Right. I mean, it's hard to say, but obviously having access to information is a good thing, but you're right. In theory, it could backfire. I mean, definitely the ease at which you can access, your financial documents and information and act on market news is, obviously it has its drawbacks. I still think it's a good thing that we have information, but that's why I always like to just tell people, all right, well, be careful with what you do with that information. And again, don't be reactive. I would say the same thing right now this week, even to someone who, for example, is looking to retire in 2021. That's a little bit scarier because in that case, you don't necessarily have the option to leave your investments alone for years and years and wait for a recovery. But let's also remember that most downturns don't last years. They last a few months and then things slowly but surely pick back up. So I think with regard to market movement this week, and as a non-medical professional, I think with regard to the coronavirus itself, I think the takeaway here is to just stay calm. Let's stay calm. Let's see what happens. There's a lot of news reports out there saying that, for the overwhelming majority of people who get infected with this virus, it's basically like an elevated cold. It's comparable to the flu. And I mean, God, could you imagine if the market moved around like crazy every time a flu outbreak happened? I mean, we'd have craziness from November through the end of March, or whatever flu season is every single year,
Well, I think context is important. And again, when you look at the news organizations, they're trying to sell headlines and get eyeballs. What drives eyeballs is talking about things incessantly, whether it's this, whether it's something else. And so they have a vested interest in doing that. I think people can inform themselves, learn, you can read things online, you can go to reputable sites to get more information, but the overreaction is something that certainly you want to avoid. And Mari, not to take it, I know we're limited in terms of time, but not to take it in a completely different direction, but that we had the passage of the Secure Act in December, and part of that was allowing for retirement income products within retirement plans. And I wonder, is this an advantage, this market turbulence, to things like annuities, fixed annuities, variable annuities? I know in 2019, LIMRA just reported that annuity sales were the highest they've ever been in the last 11 years. And I wonder if this market volatility, people will say, you know what? I need a safe haven. I need a place to go. And I can't go to gold because gold's too expensive. I can't go to money market because money markets pay nothing. Do I lock in some of my money in an annuity or an annuity-like product in order to provide some level of guarantee?
Right. I think annuities in general are not a bad idea, but I would caution and advise to definitely max out different tax-advantaged savings options before putting your money into an annuity. I think if you're maxing out your 401k or IRA and you want that added assurance that an annuity can provide, then once you've done that and you've diversified in other ways and you have extra money, yeah, sure, why not? Put it into an annuity. There are certain drawbacks with annuities. They're complex. They charge a lot of fees.
Yep.
So they're not perfect. On the other hand, there's something to be said about guaranteed income, whereas when you put money into an IRA or a 401k and the market goes a little crazy right before you need to make a big withdrawal, you could get a little burned. It's true, Jeff. It could happen. So definitely something, I guess, to keep in your back pocket.
Yeah, and I'm not to suggest that everyone should put their money in today. If you're a 20-year-old, doesn't make sense. If you're a 40-year-old, doesn't make sense. But it's an option. And I'm just wondering if it's that, everyone I forget who said, you never let a bad, circumstance go to waste. And I'm wondering if you'll see more advertisements from annuity providers or people who are creating products because, look, people, especially people near to retirement or in retirement, are going to be concerned. And I would, rightfully so, right? I mean, we don't know what to make of this market turbulence. But I think back to your comments previously, need to have a sense of perspective. And we've been through this many, many times before. And the reality is we're going to be through this many, many times in our lives, not just today, not just in the past. It'll happen. We've had a great bull market run, and recessions do happen. And I'm not suggesting that there will be a recession, but these things happen.
Yeah, these things happen. It's been over 10 years since we've had a recession. We're kind of due for one just based on historical data. So, again, I think the takeaway is don't panic, but prepare. Have an emergency fund. Kind of figure out what your backup plan might be if you were to lose your job, things like that. But more so than that, I think it's always better to take action than to just sit there and freak out.
Absolutely.
So,
well, good.
So spend that energy taking action.
Well, this is why I think our listeners like hearing from you and the other contributors, is that you give a sense of perspective and a sense of proportion and actually calm the nerves. And I think that's really important, because so much of market trading and reaction is emotional. So, Mari, always a pleasure talking with you. Enjoy the rest of your weekend, and we'll talk to you again.
That sounds awesome.
Thanks,
all right,
Mari.
keep calm, everyone. Bye, Jeff.
Bye.
I have to find a contraceptive. You never know, she could be earning her man and learning her man. And at the same
Welcome back.
time,
Now it's time to shift gears, talk a little real estate. Joining me on the line is Market Watch's intrepid real estate reporter, Jacob Passy. Hi, Jacob. How are you?
I'm hanging in there. How are you?
I'm hanging in there as well, watching the markets, feeling a little unnerved, obviously, like everybody else.
Yeah, no, it's been a busy week for us to write about finance and things. So lots going on.
Yeah, certainly. So let's we like to break down the different sectors, talk about a lot of different things on this show, and you bring us the latest in real estate. So what can you tell us? What's going on in the real estate world?
Yeah, so, I think you and I have talked a bit in recent weeks about mortgage rates. So mortgage rates this week dropped back down to the lowest level they've been at since 2016, since October 2016. So not necessarily like a new low. It's matching a low that they reached a few weeks ago. But then earlier this month it looked like the virus might have been more contained, and then obviously this week lots of cases cropping up all across the globe. Concern about spreading here in the U.S. And as that drove markets into a downward slide. It also, caused the Treasury yields to drop. And I think you and I have talked about that before. Mortgage rates don't, necessarily track Treasury yields exactly, but because mortgage rates are longer-term interest rates, they do tend to track that more than they do, other interest rates like the federal funds rate. So, I'm guessing listeners kind of know how this all works, but the Treasury yields drop when there's higher demand for them because that's a flight it's a flight to safety, and there's the relationship between price and yield. When bond prices go up, yields go down, and vice versa. And so lots of people have been, lots of investors have been flocking to treasuries because they offer, a kind of a safe haven when the market is when the stock market's doing what it's been doing this week. So one interesting thing to note, though, and this is, not just, my story that I wrote this week didn't just touch on, how they fell back to this low, but it asked the question, will we see a new all-time low? So the all-time low in terms of mortgage rates was reached back in November 2012, kind of in the wake of the recession, when the average rate on a 30-year fixed-rate mortgage fell to 3.31%. And right now we are at 3.45%, so not that far off. But there's a few reasons why mortgage rates won't necessarily drop to that, record low or drop even lower than that. So first off, the mortgage rates have not been, closely tracking the movement in Treasury yields. Now they are falling because Treasury, the 10-year Treasury yield has fallen. That is happening, but the 10-year Treasury yield this week did hit an all-time low, and that obviously did not happen with mortgage rates. So a lot is going on at the national, and international level when it comes to the coronavirus, and that's obviously driving all the market movement, or most of the market movements we're seeing. But mortgage lenders right now want to be able to stay nimble, and they can kind of hobble themselves if they drop too low too fast with mortgage rates. This is kind of a constantly changing situation. If a vaccine were to come out, if the rates of new infections were to drop significantly in the next weeks or days, Treasury yields would probably climb back up. The stock market would improve, but then lenders could find themselves with having locked in super low rates when the economy looks like it's improving. So they are being a bit more conservative when it comes to lowering rates. Another big issue, which is interesting, is there's concerns related to investors who purchase mortgage loans, purchase mortgage-backed securities. So the way those securities are, the way you earn money on them is basically through the interest payments. You basically are collecting a portion of the interest payments that mortgage borrowers are making when you purchase a mortgage-backed security. I mean, there's lots of machinations there, but that's basically how it works. And a concern right now for for MBS investors is, if rates do drop lower, that will spur, we're already seeing record levels of, recent record levels of refinance activity. It's more than double what it was a year ago. But if rates were to drop lower or drop to an all-time low, that would, it would be, a tidal wave of people looking to refinance potentially. So, and what that means for MBS investors is if, the loans in your, pool, if people refinance out of those, they pay them off early, so you stop, that basically cuts the gravy train short for an MBS investor in a way. So so there's also an extent to which the mortgage market doesn't want rates to go too low too quickly, because that could cause problems down the road for MBS investors. So lenders are having to consider a lot right now. A lot of lenders service their own loans. That's another factor. If someone refinances to, if you're a servicer and someone refinances with another company, you lose that business. So lots going on. So I mean, definitely folks who are homeowners or looking to buy should keep an eye out on rates. I think you and I have talked before about all the considerations going into refinancing, but it's definitely something to keep an eye out on. But there's definitely a chance that we're not going to see an all-time low because of the coronavirus, at least not for some time.
Yeah, Jacob, it's often hard just to point to one thing that drives the market, right? I mean, it's usually a confluence of factors. But I was reading a few of your pieces this week, and I know that pending home sales rebounded in January. Does something like that, because of low, part of that was a result of low interest rates. I mean, how do you juxtapose the pending home sales against, which increased? How do you juxtapose that against the inventory? Are we seeing a bit of more inventory now being created as a result of this demand, or is it still way off?
No, that's a great question. So also this week, new home sales figures came out, and those reached the highest level since 2007. Which is, it kind of goes along with what we've been seeing in terms of record levels of home construction. Home permitting soared to the highest level in 13 years back in January. So it makes sense that new home sales are picking up. Because a lot of people, like you said, the home supply issue is a major issue. So, interestingly, the pending home sales index, that economic indicator only tracks existing home sales. So it doesn't really pick up what's going on in the new home sales market. The rebound was in part because December's figures were so poor. There was a massive decline in December, and so it rebounded, but that doesn't mean it necessarily increased. It kind of just got the market back to where it was before the decline in December. Some of that is because interest rates came down again in January, and so because interest rates came down again in January, that spurred, there was a lot of talk about how the spring home buying season was getting an earlier start because of that, and that's still very much the case. So that was probably a feature, but pretty much every housing economist you talk to right now will tell you that something that's going to be a major hurdle for the market, for the foreseeable future is just the fact that there's so little supply of homes on the market, so many people who want to buy are just struggling to find anything to buy. Yeah. There was interesting data that I'm actually writing a story about right now that came out from Freddie Mac that kind of looked at the housing supply shortage from a state level, because we always talk about it kind of from a national level, but it's really interesting how it shakes out from a state by state basis. Some of the states that have major supply shortages are kind of expected, like California does, New York does, Florida does, but also some states that may be a little bit surprising or maybe not, depending on how closely you track things. But Oregon was actually the state that has the biggest deficit in terms of its housing stock, and that includes homes for sale and rentals. So and Minnesota also has a very high housing deficit. So when we talk about people struggling to find homes to buy, we're not just talking about the coasts. We're not just talking about California. We're talking about Minneapolis. We're talking about Portland. We're talking about even there are still it's not major deficits, but states like Iowa, South Dakota, Nebraska, they are even seeing deficits right now. Not necessarily as in parts of those states, certainly in rural areas, it may not be as bad as it is in the more major metropolitan areas in those states, but this is a national issue. So just something to keep in mind. Those figures will, existing home sales and pending home sales figures will definitely be influenced by the supply shortage. Now, one other thing to consider with all that is the interest rate question. So there's kind of an ongoing question about whether or not people are rate locked into their homes. The jury is kind of out on that, but that concept is basically like people have refinanced into such low interest rates or bought their home in the wake of the financial crisis with such low interest rates that, for them to purchase a home, they're not only facing a more expensive home in terms of, the actual, just home price, but they're also facing a more expensive mortgage in terms of the interest rate. So if interest rates continue to come down, if they do end up touching, that all-time low that was set back in 2012, then we might see some people who might be rate locked in, quote unquote, rate locked into their homes coming back into the market. And so, if they come back into the market, they're going to put their home up for sale, and that helps grease the wheels a bit.
Yeah, Jacob, I don't know if we've talked about this. I was kind of curious about commercial real estate. I'm not sure if this is actually part of your beat, so forgive me for asking this question because but what's the impact? Do you think about going back to the coronavirus? We know that earnings season could be muted, right, and that will have an impact in a lot of because of the supply chain in a lot of different areas. What's your take on commercial real estate and how commercial real estate is doing? Because many people out there may own REITs. They may not just own piece of a trust. So just wanted to get your quick take on that.
Yeah. So, real estate stocks have fallen this week. I don't cover commercial real estate as much, but I do cover it.
Bless you.
Sorry about that.
No.
So actually, give me 1 second. I'm having a sneeze attack.
Okay, sneezing attack. We're going to take a brief break.
Sorry about that.
No worries.
Muted
Jacob,
Oh,
that would have been interesting to hear. I think I'm going to say a collective.
I swear I don't have coronavirus.
All right, and a collective bless you from our audience, Jacob. So
thank you.
As you were saying about real estate, I've got about 2 minutes left.
Yeah, so, commercial real estate, not necessarily my beat, but, there is an extent to which it could hold up well. Some economists have suggested that, commercial real estate investments should hold up fairly decently. There's an extent to which, but there's also an extent to which, it depends on, what you're talking about here. So, hotel, if you're in a REIT that is a lot of exposure to hotels, depending on how this affects travel, and travel companies. Hotel REITs may not be a great investment right now, because if a hotel chain is already kind of on shaky ground, and then this is the straw that breaks the camel's back, then that might be bad for those investments. But there's a lot of this is a remains to be seen situation, and depends on how long the global economic impact will be. One thing to keep in mind, if you're talking about commercial real estate from in a direct investment standpoint, and you and I have, I think, talked about this before, but there's an extent to which the coronavirus has caused a slowdown in terms of foreign real estate investment here in the U.S., especially from China. Chinese investors are just not able to Chinese nationals are not allowed to enter the U.S. right now if they've been in China within the last 14 days. So they either have to, go to another country and wait it out and then come to the U.S., or are not able to enter whatsoever. And so those realtors I've spoken with have suggested that will cause a decline in investment activity from China into the U.S. real estate market for the foreseeable future. So while Chinese investors certainly buy a lot of residential real estate, they also buy commercial real estate, and that could provide opportunities to folks depending on where you are.
Yeah, absolutely. Well, a lot to think about, and certainly lots of considerations out there given the coronavirus. And Jacob, really appreciate you coming on the program, and make sure you Purell as soon as you and your phone as well. Jacob Passy, always a pleasure talking with you. Have a great weekend.
Thank you. You too.
Bye.
From a young G's perspective. And before me, they got a trick, I have to find a contraceptive. You never know, she could be earning her man and learning her man. And at the same time,
welcome back. Now we're going to shift gears, talk a little retirement. Joining me on the line is Alessandra Melito. She is the retirement reporter for MarketWatch. Hi, Allie. Welcome back to the program.
Hey, how are you?
I'm doing quite well. The markets, I got to tell you, the markets are giving me a little bit of a cause for some trepidation. But I'm happy to be here, happy to chat with you. So what's top of mind for you and the folks over at MarketWatch?
Yeah, so I, of course, have been watching the stock market as well. And one thing that has been happening numerous times this week, aside from the fact that, aside from all the market volatility, is that some investors have been having a lot of issues getting into their investment accounts. So about a week ago, it was Wednesday of last week, there was a glitch on Fidelity where people, when they signed in, if they could sign in, when they signed in, their accounts were a zero balance. They weren't able to see all of their accounts, or they couldn't see what their balance was for certain accounts. And people were tweeting oh my God, my 401k looks like it's zero. I know it's not true, but still very stressful to log in and see that. So that was about a little more than a week ago. And then earlier this week, some investors were having issues getting into accounts at Fidelity, TD, and Schwab, where they either couldn't access it right away, or if they could access it, they were having trouble seeing trades or making trades, things like that. And then it happened again today. So it appears that investment firms, there are just so many people logging onto their accounts and trying to make trades of all different types, that the systems are just lagging. In some cases, people can't log onto their accounts whatsoever, but in other instances, they can log into their accounts and they can even make a trade, but they might not see the trade confirmation for 10, 15 minutes. So it has been very stressful on top of an already quite stressful situation.
So any rationale as to why? Glitches happen all the time. It's an imperfect world. Sometimes systems don't align. There are batch processes that run behind the scenes. But any indication as to what might have caused some of these outages, for lack of a better term, Al?
So they say that it's not like a website crash or anything. A lot of the firms are saying that it's just heavier than normal volume for like making trades or logging in and things like that. So it's just, I guess it's just their site doesn't have the bandwidth to handle all these different requests at the same time, and everything's being slowed in the process. Unfortunately, that means for certain investors, if they're trying to log in and make a trade or just see their account, they're getting locked out of it. And I know that like financial advisors tell you, don't look at your account during market downturns. You don't have to see it, all that stuff. But still, it brings people, relief to be able to log into their accounts. So, yeah.
Yeah, I would say that the first thing you want to know is that you have access if you need to be able to check your account. So not necessarily that that would just make you feel better, right? I would imagine that if the markets are going down or you want to check your balance, you have the ability to do that. If not, I would just be concerned because, hey, what happened? Why can't I do something that I'm told that I can do? And I would imagine that there were lots of phone calls, Allie, to the customer support service center and to the employers of those retirement, the clients, right? They're going to get, hey, the Fidelity website's down, or the E-Trade website's down, or TD account is down, right? I mean, I'm sure that generated lots of phone calls, lots of inquiries.
Yeah, well, I actually found out about all of this because of Twitter. A lot of people were tweeting like, "Oh, I can't get into my Fidelity account," or "Oh my God," they would post like a screenshot, be like, "Oh my God, look at my balance, it's $0," or like, "Hey, financial firm, I've been trying to get online, for 15 minutes, and now I'm calling and I'm on the phone for another 20 minutes." So the companies are definitely hearing something from the investors who are locked out. And they did say that it's not, this wasn't like a site-wide thing. It was, a lot of the firms that I spoke to said it was a small number of people for a small amount of time. But still, it's disconcerting when you're seeing so much happen in the markets, and then you try to log on and see your accounts, or if you're like an investor who does day trading on the side or something like that, you not be able to act based on the moment that you want to act on.
Yeah.
It could really affect your strategies. For like the everyday person who's saving for retirement, they should not be making trades based on market volatility for their portfolios. Like they should stick to their strategy, because this is just part of life. But for people who do this for a living, or who do this as recreational hobby, and they like watching the markets, and they like acting on it, and picking different funds and stuff like that, it could be upsetting if you can't make the trade at the moment that you want to make the trade, because as everything changes within minutes. So yeah, it's just been just adding to the craziness of this week.
Yeah, and I know you and I spoke about how you got a little bit of blowback on the word entitlement using in your article. We talked about Social Security. I guess it's kind of nice to see I don't know, it's kind of a backhanded compliment, but it's nice to see someone else get kind of raked over the Twitter coals, right? And, so another focus. I mean, it's not nice to direct focus on someone else, but, kind of removes that focus on you and your choice of words, I guess.
I'm sure more people will be angry at me for something else soon.
Well,
it's okay.
You know what? They're just, if they're angry at you, they're really just angry at themselves, Allie. And that's all I can say. Allie, always a pleasure chatting with you. Thanks so much, and let's hope those outages get fixed. People have access, because that's really important to people. It makes it feel comfortable. So have a great weekend, and we'll talk to you very soon.
Yeah, talk to you soon.
Thanks. Bye.
From a young G's perspective, and before me they got a trick, I have to find a contraceptive. You never know, she could be earning her man and learning her man.
Welcome back. Now we're going to wrap things up with what may be going on with retirement legislation, regulation, and litigation, so much more. Join me on the line. He is one half of the Legal Eagles. They are retirement rock stars. Principal with Groom Law, Kevin Walsh. Hey, Kev, how are you?
Good, Jeff. It's always good to be on the show.
It's always good.
It's been an exciting week in the world of ERISA, so it's a good week to be flying solo.
It's been an exciting week in the world of ERISA and unfortunately in the stock market. But let's stay focused What's top of mind for you and your colleagues at Groom this week?
So top of the mind for us this week is that the Supreme Court released an opinion on Wednesday dealing with ERISA. And as we've talked in the past, there are some terms where there's 0 cases. This year there's a couple cases. So it's been a really busy term for ERISA cases. And this week we got the decision in Intel versus Solmea.
Wow. Okay. So break it down for us. I mean, do you mind just summarizing what the issue was?
Yeah. So here, and it's not the sexiest of issues. It comes out of statute of limitations, and under ERISA, you have 6 years to sue from the end of a fiduciary breach. So 6 years, but that 6-year statute of limitations gets shortened to 3 years if a potential plaintiff has actual knowledge of kind of the circumstances surrounding the breach. So the case here really came down to, what does it take for someone to have actual knowledge? And the defendants were saying, we mailed these participants a disclosure that explained everything. They received it. For some of these, it was accessible through a website, and it's clear that they accessed the website. Is that enough for us to say, look, they had actual knowledge of the circumstances, and they only get 3 years to sue instead of 6? And the Supreme Court came out and said, no, that's not enough. So they said, you've described something that would be constructive knowledge. So, you've laid out facts that would make it seem like a reasonable person would have knowledge. But Congress here, in its infinite wisdom, used the phrase actual knowledge. And actual knowledge, according to the Supreme Court, doesn't just mean that you delivered something to somebody, but it means that they read and understood the document.
Ah, okay.
So this is kind of a big deal because, the plan sponsors I've spoken to are kind of throwing their hands up and saying, well, why are we bothering with all these expensive disclosures, mailing them out, making sure they're readable, if the presumption is going to be that people don't read them?
And don't understand them, right? I mean, they read them and don't understand them.
Yeah, or that they just, here the plaintiff said, did you get, when asked if they got the disclosure, they said they didn't remember. And I would assume that, if you read something more than 3 years ago but less than 6 years ago, which is the fact pattern where this is relevant, there's going to be a whole lot of things that you might have read and understood at the time that you won't remember.
So I sense some frustration or at least you're indicating that there may be some frustration on the part of employers, right? What's the impact here? Is the impact we're no longer going to? If no one's reading them and we don't know that they actually understood what they read, then why are we bothering? And so let's just save money and time and not do it. Where are we headed with this?
The impact here really is going to be that, at least in the short term, you're going to see you'll see more plaintiffs try to put together classes of participants where something occurred in the past 6 years. So you'll see kind of twice as long a time period as you'd see or a 3-year limitations period, which could lead to more expensive claims. The other thing that we'll see here is I think we'll see a shift among plan sponsors and among service providers to finding ways to kind of get confirmation from folks that they've read and understood things. So we've talked about electronic disclosure and how DOL has a rule pending. One thing that wouldn't surprise me is after that rule's finalized or where electronic communication is used now, if we start seeing either more disclosures just pop up that people have to scroll to the bottom of before they can click through, or different tools be developed where participants are asked, did you receive what you just read? And in theory, we could start to see kind of plan sponsors keep track of what participants have clicked on as a better tool for showing who read what, so that the I don't remember if I read it defense is or claim is a little bit tougher to make going forward.
Yeah, I was going to say, it used to be, I could see people going in that direction, right? Keeping track of keystrokes and clicking and when you open something. And you can do some of that, I guess, today. But in the past, if you sent someone a letter, they could always deny that the letter got delivered, right? You could see a post date, you could see a copy of the letter that was scanned and on the record-keeping system and available. But at the end of the day, you don't know if it actually made it to that person. This is one way to validate that.
Yeah, well, and in this Supreme Court case, it wasn't even enough that there was clearly a way for it to get to the person. I mean, they said they have to have actually read it. So getting it through my mail slot doesn't mean I read something. There's a whole lot of mail that goes straight from my floor back into the trash can.
and Kevin, for many of us that are registered representatives, so you're Series 6, 63, 7, et cetera, we have to take continuing education. So you're supposed to read the continuing ed, and then they might take a quiz. And at the end of the quiz, you get like a little certificate, and that certificate goes to your employer, goes to the compliance person. And I'm wondering if we're headed down that road where participant ABC receives something regarding the new target date funds that are being added, or whatever the case may be, and then they have to take a quiz. That just seems like, I mean, we need education, right? But I mean, that just seems like a really onerous thing to dump on somebody.
Well, I mean, particularly if the idea here is that if someone's switching investments in their plan lineup, so they're switching from one fund to another, and you're trying to show that they read the prospectus. I mean, are you going to have a quiz every time someone tries to initiate a fund change? I mean, it seems like I think a workable solution will come up,
right?
But I think in the interim, it's likely we see kind of a handful of efforts or seeking out DOL guidance or even trying to get Congress to change it so that constructive knowledge is sufficient.
Yeah, well, very interesting. Well, David. Kevin, thank you so much for joining us on the program today. Really appreciate your time, and look forward to speaking with you next week. Thanks for joining us solo.
Oh, thanks for having me on. Talk to you soon.
Bye-bye.
Bye.
Well, that wraps up this episode of the BRN Sunday podcast. I want to thank you, our audience, for tuning in. Really enjoy doing this show. Don't forget, we're back again tomorrow morning for the BRN AM show. I'll be joined by special guest Rick Seltzer of Inside Higher Ed. So until next week, I'm Jeff Snyder. Keep on saving, and don't forget, roll with the changes.
Drake creep to the mic like a fan.